The MCA, or Mortgage Checking Account System, is the advanced debt elimination strategy offered through WeXL Financial. Hi, my name is Milo LeBaron, and today I'll be going through a presentation that will explain some of the details of how the mortgage checking account system works and also how it will benefit you. Before we proceed with this presentation, I'd like to compare purchasing, or rather understanding the MCA system, to purchasing a computer. Normally when you walk into the store and you're looking at purchasing a computer, you don't typically ask the representative to open up the computer and explain to you how all of the parts work inside of it. What you are more concerned about is the type of computer. How easy is it going to be to use? What is it going to take to manage that computer? Not to mention the fact that when you purchase the computer, you walk out of that store with a 100% money-back guarantee. A guarantee that if the computer does not work or if it breaks, you can get your money back or they will fix it for you. The MCA system has a money-back guarantee very similar to that. We guarantee the accuracy of this program. Even though we are going to be discussing some of the details of the mortgage checking account system and the concepts behind what makes this system work, if you don't understand them right off the bat, that's okay. A typical client will take about 3 months to really comprehend what's happening with this system because it is a paradigm shift. We are teaching you to think about money completely different from how you have thought about it your entire life. So let's proceed with this example and talk about how the mortgage checking account system works. In our example, we will start with a $200,000 loan at 6%, a line of credit at 9% with a $20,000 limit and a $0 balance. Now, this line of credit is your mortgage checking account. That's what we call it. It is a line of credit that can be a home equity line of credit, an unsecured personal line of credit, a business line of credit, or even in some cases, a credit card will work as your line of credit. The line of credit that you use as your MCA can typically be acquired through the bank or credit union that you currently bank with. If you don't have a line of credit, we will help you find one that will work as your MCA. The very first thing the software is going to instruct you to do is reposition a specific amount of debt from your mortgage into your line of credit. Let's talk about what we mean when we reposition debt. For our example, we are going to use the amount of $6,000, writing a check for $6,000 from the line of credit and paying down the first mortgage brings the balance from $200,000 down to $194,000 on our mortgage. Let's for a moment ignore what we just did in borrowing that money from the line of credit and look at the results of what just happened in our mortgage. We saw some instant savings, 2 years in savings on our payoff, $28,000 in interest that we're no longer having to pay, and now when we make our mortgage payment to the bank, $30 a month more is going towards the principal than it was before. These are phenomenal results that we were able to accomplish with the bank's money, borrowing it from the line of credit. Now the only problem, and I'm sure that you're thinking this, is that we owe $6,000 on this line of credit. And not only that, we owe $6,000 on a line of credit with a 9% interest rate. Now that doesn't make a whole lot of sense, does it? Well, let's talk about why it does make sense. On a monthly basis, normally you would take your paycheck and as soon as you receive it, deposit it into your checking account at the bank. Unfortunately, the bank is not going to pay you much, if any, interest for keeping that money there. Rather than taking that paycheck and letting the bank use it to work for them, we want to put that paycheck to work for us. So we're going to pay that paycheck towards the balance of this line of credit, bringing the balance from $6,000 down to $200. Now at this point, I'd like to ask you a question. Would you rather pay 9% interest on $200 in the line of credit or 6% interest on $6,000 in the mortgage? Well, I think the answer is obvious. We would rather pay 9% interest on $200 all day long. So let's pause for a moment and see what we've been able to accomplish thus far. We've been able to pay off $6,000 of our mortgage, saving us years on our payoff, thousands of dollars in interest, and improving that principal to interest ratio on each payment we pay to the mortgage. Not to mention the fact that all of the negative results that came from borrowing the money from the line of credit have been eliminated, virtually eliminated, because we are putting our money to work for us, offsetting the debt balance in the line of credit. Now, we only run into one additional problem. we usually have to take that $5,000 or $5,800 that we received as a paycheck, and we have to use that to pay for monthly expenses. So what do we do about our monthly expenses? The great thing about this line of credit that you have is that it works just like a checking account. You can write checks, you can do bill pay, you even have an ATM card so that you can go withdraw cash from this line of credit. The main difference here is that it's not a positive cash balance, and your money is actually working for you as it stays in this line of credit in saving you interest. So, moving forward under those assumptions, if our monthly expenses are $3,000 throughout the month, we see that slowly throughout the month, our balance in the line of credit is increasing because all we're doing is taking that income that we deposited back out, increasing that balance back up to where it was before. Now, there's only one problem with this strategy. The way that interest is calculated in this line of credit is not like a mortgage or like a credit card. It's based on an average daily balance. In other words, as your balance in this line of credit increases throughout the month, so does the amount of interest that you have to pay. Our goal should be to keep the balance in this line of credit as low as possible for as long as possible during the month. In other words, we want to try to avoid taking our money out of this line of credit in order to pay monthly expenses. This is where we introduce the second part of this system, where we will teach you to use the bank's money to work for you. By using a credit card to pay for as many of your monthly expenses as possible, the bank has essentially said that they will pay for your monthly expenses, and as long as you pay them back at the end of the month, they won't charge you any interest. Not to mention the fact that they're probably going to give you some pretty good reward points for using their credit card. So by using the bank's money, interest-free on a credit card, you're able to keep the line of credit balance as low as possible for as many days as possible during the month. You have now become the bank so that your money is working for you and the bank's money is working for you. Now at the end of the month, we'll pay off our credit card and pay our mortgage payment, which will bring the balance back up for a short period of time. Then shortly thereafter, we will deposit another paycheck into the line of credit, bringing the balance back down. Now normally at this point, the software will have you reposition more debt in order to accelerate the payoff of your mortgage even further and continue to use your money to work for you. At this point, it's very important to remember that this system does not involve any magic. It really just comes down to math. There are 3 simple steps that you need to follow in order to earn our 100% money-back guarantee. Again, if you didn't understand anything we just went over, as long as you can do these 3 things, you will see success using this program. Number 1, we want you to change where you deposit your paycheck. Rather than depositing it into a checking account where it's working for the bank and doing nothing for you, we would rather you take that money and deposit it into your line of credit where it can save you interest. Number 2 is we want you to use a credit card for as many of your monthly expenses as possible. Now, this is not entirely necessary if you don't feel comfortable or if you don't have a credit card that you can use. That is not a necessary component of this program, but it does add additional benefits. Number 3, we want you to consult the MCA software once a month for about 10 minutes a month, and the software will instruct you based on your different monthly variables of how much you make and when you make it, how much you spend and when you spend it, the different interest rates attached to the debts that you have, and the amount of payments that you're making each month. The system will look at all of those different variables, and based on those variables, it will instruct you to reposition debt each and every month. If you follow these 3 steps, you will earn our 100% money-back guarantee. Remember that our average client, just from implementing these tools and this system, without any change to their lifestyle, is able to shorten their payoff from around 30 years down to around 8 to 12 years. And they're able to save over $200,000 in interest on average just from implementing the MCA system. If these are results that you would like to achieve, then the MCA system is for you.